You know how some topics on a company's balance sheet seem a bit, well, other, like they don't quite fit into the neat, established boxes of cash or core machinery? Today, we're taking a deep dive into exactly that, the fascinating, often overlooked world of other assets. We've got a fresh set of sources here, specifically an updated chapter from April 2023 that maps out this category, assets not typically covered elsewhere. So our mission for you, our listener, is to unpack what these other assets truly are, why they matter, maybe more than the name suggests, and what surprising insights they offer about a company's real health.
Yeah, it's true. They're called other, but honestly, they're incredibly important for getting the full financial picture. We'll get into everything from how companies account for, say, customer debts,
Uh-huh.
all the way to their internal software, even their spare parts inventory. It's really about spotting the patterns, connecting the dots, for a fuller understanding.
Okay, let's unpack this then. The sources basically say other assets are the ones not explicitly covered in other, more focused guidance chapters. So, high level, what sort of things are we actually talking about? What's in this catch-all category?
Right. Think of it as the significant bits that aren't your cash, major property, or investments. The document points out several key types. First, receivables, that's money owed to the company.
Hmm.
Customer invoices, things like that. Then there's inventory, pretty straightforward. The goods a company has ready to sell. We also have prepaid assets, so expenses paid in advance, like maybe next year's insurance premium. Long-lived assets are in there too, your property, plant, equipment used over many years. And then it gets interesting with capitalized software, the cost of developing or buying software that's treated as an asset because it'll benefit them down the road. And finally, the really non-physical stuff. Intangible assets like patents or trademarks, and goodwill. Goodwill's that thing that pops up when one company buys another for more than its identifiable assets are worth.
Okay, Goodwill, intangibles. Got it.
And it's also super helpful to know what this chapter doesn't cover. That helps define the scope. It specifically leaves out things like cash investments, lease receivables, contract assets, because those all have their own dedicated accounting rules elsewhere.
So, they're other, but definitely not Wild West. There are rules. What's the main rule book guiding how companies report them? And, like, why should we care about that?
Yeah, absolutely regulated. The primary guidance, the main rule book, is US GAAP. That's generally accepted accounting principles. Think of GAAP as the comprehensive instruction manual for U.S. companies on financial reporting. And within that, the sources list specific ASC topics, accounting standards codification, like chapters in the manual. So ASC 310 is the chapter just on receivables. Tells you exactly how to handle them. It's all about consistency, comparability, right? So you can look at different companies and make sense of it.
Okay, so GAAP is the big book, ASCs are the chapters.
Exactly. And for companies listed on stock exchanges, the SEC registrants, there's also Regulation SX 502. That gives even more specific presentation rules for the balance sheet. Knowing this framework means you can generally trust that companies are following the same playbook, which makes it easier for you to compare their financial health.
Right. Okay, now here's where I think it gets really interesting. Accounting rules aren't set in stone, they change. And these sources flagged some pretty significant recent updates that genuinely changed how companies report these assets. What shifted? Why are these changes important for us?
That's a crucial point. These updates really do impact how you read a company's health. The document points to two major ASUs, accounting standards updates. Think of them as big revisions or new chapters for the GAAP rulebook. The first is ASU 2016-13, Financial Instruments Credit Losses. This was a game changer. Historically, companies only booked a loss for bad debt when it was pretty much certain, when it was incurred, like the customer already defaulted, it was reactive. But this new rule, companies now have to estimate expected credit losses before they happen, based on forecasts, history, economic conditions. Is proactive, forward-looking, trying to anticipate problems.
Wow, okay, so they have to be crystal ball gazers with their debts now. That seems like a huge shift in mindset about risk.
It really is. Forces them to be much more forward-looking. This kicked in for most public companies starting after December 15, 2019. And then a related update, ASU 2022-02, treat things further. It got rid of specific rules for troubled debt restructurings, or TDRs, for companies using the new credit loss model, and brought in new disclosure requirements instead.
Okay, so that was the first big one. What was the other major update you mentioned?
The second one is ASU 2017-04, Goodwill impairment. Remember Goodwill, that intangible asset from an acquisition, the premium paid, basically.
Right, the extra bit.
Exactly. Now, testing, if that goodwill has lost value, what we call impairment, used to be this complex two-step process. This ASU simplified it. It basically eliminated step two. Companies don't have to do this complicated calculation of the implied fair value of goodwill anymore. It streamlines testing if goodwill has lost value. This was effective for public companies starting after December 15, 2020. For you, the listener, the practical thing is, it's now maybe a bit clearer and quicker to see when goodwill impairments happen. And that can signal an acquisition isn't panning out as hoped.
Okay, simpler tests for goodwill. Got it. Let's dive deeper into some of these categories then, because they each tell a story. Let's start with receivables, the money owed to the company. What's the key thing for someone trying to understand those?
Well, under ASC 310, the detail is fascinating. It's basically a company's contractual right to get cash. The sources distinguish between your standard accounts and notes receivable, think typical customer invoices and financing receivables, like credit card balances or loans. But the crucial part for you are the extensive disclosure requirements. Companies have to spell out how they account for loans, how they recognize interest income, and critically, their allowances for credit losses.
Okay, the allowance, that's their estimate of what they won't collect.
Exactly. It's their best guess of the bad debt. And how they calculate that allowance is key. They have to disclose the factors they consider history, current conditions, forecasts. So if you see a company's allowance suddenly jump up, that's not just accounting noise. That could be a major red flag. Maybe their customers are struggling, maybe the economy's shaky, or maybe the company's just getting much more worried. It gives you a real-time pulse, sometimes before the revenue numbers officially reflect a problem. It's a window into risk management.
Okay, that makes sense. A key indicator. So if receivables are money owed to them, what about inventory? That's the physical stuff, right? Goods on hand. What do we need to know there?
Exactly right. Under ASC 330, inventory is obviously huge for many businesses, and how they value it can tell you a lot. Companies have to disclose their basis of accounting for inventory, how they assign costs. This means methods you've probably heard of. FIFO, first in, first out, assumes the first items bought are the first sold. Or LIFO, last in, first out, assumes the last items bought are the first sold. And there's the average cost method too.
Why does that choice matter so much? FIFO versus LIFO.
Well, think about rising prices. If costs are going up, under LIFO, the most recent, higher costs hit your cost of goods sold first. That means lower reported profit, maybe lower taxes. FIFO would do the opposite older. Lower cost hit first, leading to higher reported profit. So the method chosen tells you something about management strategy, maybe tax planning. The sources also mention disclosures for things like spare parts and stores items. Less common, maybe, but vital for industries like airlines or heavy manufacturing. Shows how detailed reporting can get, right down to the nuts and bolts.
Interesting. Okay, moving on. Prepaid assets. Seems simple paying ahead, but you mentioned advertising costs have some wrinkles.
Yeah, they do. And it offers a neat peek into marketing strategy under ASC 340 and 720. So your basic prepaid rent or insurance, they're usually straightforward, disclosed separately, but advertising costs get specific rules. Advertising is defined broadly: traditional media, coupons, anything promoting the company or its products. And here's the choice companies get. They can expense advertising costs as they incur them, hits the income statement right away. Or they can defer them and expense them over the campaign's life. Say they pay for a big 6-month campaign up front, they can spread that cost over the 6 months.
Ah, okay. So they can smooth out the expense hit.
Exactly. They must tell you which policy they chose and the total ad spend. So looking at that lets you see how they're timing their marketing investments. Are they trying to smooth earnings or making a big concentrated push?
Got it. Okay, from spending money to the big physical stuff, long-lived assets, factories, equipment, standard stuff. But the sources focus on impairment and disposal. What do those signal?
Yeah, these are really important signals about operational health under ASC 360. What happens when these big assets lose value or aren't needed anymore? For assets held and used, companies have to check for impairment. That's if something suggests the asset's book value might not be recoverable through its future use, like a factory becomes obsolete due to new tech. If it's impaired, they have to write down its value, record a loss, and they disclose that loss amount, how they figured out the new fair value, and why it happened.
So an impairment can be a red flag about a core part of the business.
Definitely. It can mean it's struggling or facing obsolescence. Now, for assets held for sale, the rules are strict. Management has to be committed to selling it, it has to be ready for immediate sale, and the sale needs to be probable within a year. Disclosures cover why they're selling and any gain or loss on the sale. Sometimes it's trouble, sometimes it's strategic, like getting rid of a non-core unit.
Okay, now software. It's everywhere. How does accounting handle something so central that can be developed, sold, or just used internally in the cloud? Sounds tricky.
It absolutely is complex. And the accounting under ASC 985, 350, and 730 really depends on how the software is used. The sources differentiate clearly. Is it software to be sold, leased, or marketed, like Microsoft selling Office? Or is it internal use software, something a company builds just for its own operations? This distinction dictates whether the development costs get expensed immediately, hitting profits now, or capitalized as an asset, spreading the cost over time. Big impact on reported earnings.
And what about the cloud? So much software is subscription-based now.
Exactly. And that's where cloud computing arrangements, CCAs, come in, adding another layer. Often these aren't simple software licenses. You're accessing a service hosted elsewhere. You don't own the software. The accounting hinges on whether the CCA includes a software license element or if it's purely a service contract. If it's just service, costs are generally expensed as you go operating expense. If there's a software license component, some costs might be capitalized as an intangible asset. Companies have to disclose how they present these costs. Balance sheet, income statement, cash flows helping you track their digital spending.
Right, makes sense. Okay, finally, the really intangible stuff under ASC 350. Intellectual property, brand value, goodwill. How do you account for assets you can't, touch?
Yeah, these are often the toughest to value and report, but potentially hugely valuable. For intangible assets, patents, trademarks, customer lists, companies have to disclose the total amount assigned to each major type. Also, their weighted average amortization period, how long they're spreading the cost over, and how they estimate that useful life. A longer life means smaller expense each year, so that estimate matters. And goodwill, as we discussed from acquisitions, that premium paid, it's often a massive line item. Companies have to show a roll-forward reconciliation of goodwill each period, beginning balance, additions, impairments, ending balance.
And impairment testing applies here too, like with the long-lived assets and the simplified goodwill test.
Absolutely. Impairment losses on both specific intangibles and goodwill are significant disclosures. If they take an impairment, they have to explain why, the amount of the loss, and how they determine the fair value. This is critical because a big goodwill impairment can tell you a major acquisition just isn't working out as planned, a really important signal for investors.
Okay, this has all been very focused on public companies, SEC rules. What about private companies, the vast majority of businesses? Are they playing by different rules here?
That's a really important distinction. Yes, private companies often have different accounting options and generally fewer disclosure requirements than public SEC-registered companies. For example, a big one we touched on, goodwill. Private companies can choose to amortize goodwill over a period, say up to 10 years. Instead of just testing for impairment each year like public companies must, they can take a steady expense over time, can simplify things for them.
So a smoother hit to earnings, potentially, rather than a big, sudden impairment loss.
Exactly. And they also have an option to subsume certain intangible assets into goodwill. So instead of recognizing, say, a specific customer relationship or a non-compete agreement separately when they buy a company, they might just roll its value into goodwill. Less detailed tracking. And what's really interesting is that many of those super specific SEC disclosure rules we talked about, like detailed receivable breakdowns or LIFO valuation specifics, they just do not apply to private companies. Their financial statements might look less granular, but it reflects their different reporting needs and, frankly, a more practical approach for many private businesses.
Okay. We've taken quite the deep dive into these other assets, haven't we? And it's crystal clear they aren't just footnotes or some miscellaneous bucket. From that huge shift to expected credit losses changing how companies view risk, to the details of software capitalization and those different rules for private companies. Understanding this category gives a much richer view.
Absolutely. The level of detail required, especially for public companies, and how these rules keep evolving. It really highlights how dynamic financial reporting is. It's not static. It's trying to paint an accurate, evolving picture.
So what does this all mean for you, the listener? Well, next time you're looking at a balance sheet, maybe don't just skim past that other assets line. Hopefully this deep dive gives you the curiosity, the context to dig in a bit. Ask yourself, what's actually in there? What hidden insights or potential risks might these seemingly minor details reveal about the company's operations, its strategy, its future? Because often it's in these other details that some of the most interesting stories about a business are actually hiding.